surging. Aditya Sood is with us, Portfolio Manager at Incred Pms. Aditya, good to have you with us here. Thank you for your time. A bulk of your portfolio is in that space, mid-caps, small caps. Aditya, I mean, just the sheer, does it surprise you, the way things are moving, the pace at which they're moving, and very, very varied?
Not really. I think so. I think so. We have taken a overweight stance on small caps for last 3-4 months odd. I think so. What has happened is that, if you sit back and look through last 2 years, what has happened is that, obviously, it has been difficult to beat fixed deposit returns, as an equity investor. But what we have also seen is that, there are close to 2,000 odd companies wherein we have seen a very decent correction, 30 to 50%. There are some pockets wherein, stocks have corrected by more than 50%. And the call is on cyclicality here. Essentially our belief is that, most of the categories in India go through their own cycle, and especially true of small caps. Another important call is going to be how what is going to move the market going into election year, or possibly, on a 12 to 18 month basis. Our view is that, as FII flows return to the market, and we are at a very nascent stage of FII flows returning to the market. It has only been close to 20 odd days wherein we have seen buying numbers. Obviously, there is an element of a normalization of EBITDA margins for a lot of the companies. There is a combination of freight cost. Obviously, it has peaked out. There is a combination of power and fuel cost moderation. There is also a combination of raw material cost, normalizing. So that is where we find, maximum opportunity at this juncture. So result season has been, fairly heartening for a lot of small cap companies, although there continues to be divergence, within small caps.
Aditya, I just want to ask you if you've looked at 2 IT companies, and these are, the small to mid cap. One of them is Nucleo Software. On Friday, 20% higher, Monday, 20% higher, then another 10% higher. Today as well, it's up 10%. In a span of 5 days, the stock is up more than 50%. So that's one. Is this a company that you've looked at any point of time? And the other one is Cyient, a 70% rally in this year. And this comes at a time when the Nifty IT index and many of the constituents have done absolutely nothing. So, your thoughts on these 2 stocks if you have looked at them. If not, I'll go ahead and talk about, some other additions and deletions that you've done in your fund.
So no, Nucleus, I think so. It is a product company. So, obviously product companies have got a lot of operating leverage. We do have exposure in intellect design arena, which obviously is a BFSI stroke product company. As far as Cyient is concerned, it is a very straightforward case of the stock used to always trade at a discount to the sector. Obviously, there is a DLM business that they are they have. It is a late cycle manufacturing play, and then obviously they filed for an IPO. On the EMS side. So our view is that, Cyient obviously has been a, re-rating sort of a story wherein, the street has seen some sort of re-rating, but it is closely linked to, the way Cinema, Keynes, a lot of these EMS companies have done recently. So possibly, there is some value picking as far as Cyient is concerned.
All right, so that's about Cyient as well as Nucleus. Aditya, moving on to, or taking off from what Reema spoke about, additions and deletions in your portfolio, the one that really stood out was Stovecraft. You've bought more of Stovecraft. Just wanted to understand, why is it that you've done so? Because, the company has been disappointing on growth for the last many quarters. Yesterday, we had the management as well indicating that this time around, they did not grow as much as they anticipated, though they're always optimistic, but the results fail to satisfy the street. That's on one. And the other one, you believe that it's the right time to, maybe accumulate something like Jubilant FoodWorks. So trying to understand that as well, because QSR, everyone's talking about a bit of slowdown after the post-COVID, growth that we saw in that segment. And in that, Jubilant FoodWorks has actually been a bit of an underperformer. So why Stovecraft and Jubilant FoodWorks?
Yeah, so essentially, our framework says that, there are in secular categories, you get, times wherein, companies can see a cyclical decline. And this is least understood by a lot many people. So if you look at, for example, Jubilant Foodwork in particular, what you'll find is that, this is not the first time wherein SSG growth has been negative. What our framework says is that, whenever SSG growth is negative, that is the right time to look at, QSR stocks. Again, obviously, there is a bit of divergence wherein, obviously Westlife has outperformed in the near term. But what we find is that, SSG growth, negative SSG growth, the key question is that, how much the stock is pricing in. So once you see a, 30, 40, 50% correction in a lot of these great businesses, our view is that, you have to look at the sensitivity of margins to what the stock is really pricing in. And that is where I think so, the Jubilant particularly scores, obviously barbecue also is a very unique play of, where Jubilant is itself invested in that company. So our view is that, there is going to be a trend line growth. Negative SSG is not here to stay. Another thing is that, obviously there is a World Cup which is coming up. What we have seen is that, pizza consumption shoots up, as and when that happens, because it is a heavily consumed category ahead of the World Cup. So our view is that, there is going to be an element of mean reversion as far as SSG is concerned. Now, if you look at, Stovecraft specifically, what you will find is that, there is the stock got IPO'd at 450 rupees, was as high as 1100 odd rupees. Our expectation there is that, it is a combination of 7% margin mean reverting to 10-11% sort of a number. Obviously, they have reported a much higher EBITDA margin in the past. I think so. We like winners in a cycle wherein, they continue to gain market share. There was some element of, volume growth. And obviously, as a raw material headwind subsides, what you'll expect from these companies is that, the margins are going to mean revert very, very fast. So our view is that, one needs to buy at a decline to see returns which are meaningful over the medium term.
Okay, by the way, just want to point out this news that's coming in on SpiceJet that the court has now ordered them to go ahead and make a payment. I think it's 200, if I remember, 270 odd crores. No, actually it's 380 crores. That is the total payout. The stock on the BSE feeds is up about 3%. We'll just refresh and check the NSE rates as well. But on BSE, the stock is holding on to a gain of almost 3%. And SpiceJet is saying that they are in discussions with Mr. Kalanthimaran and the associate entities to look at an amicable settlement of all dues. So that's just some news coming in on SpiceJet on the sidelines. Aditya, hi, Surabhi here. I just want to go back to that point that you were making on EMS when we were discussing Cyient. What is your call on the EMS space? Because it's getting a very, very interesting sort of playing field out there. There used to be the traditional names like Amber and Dixon, but then you've got these new entrants like Keynes and Sirma. And a lot of these companies have shown, they're small companies, but they've shown very decent growth numbers in the fourth quarter. Do you like anything here, and how are you dividing it between, let's say, the more of the consumer plays, which is television screens and mobile phones, and some of these industrial electronic equipment manufacturing themes?
One filter that we start to use obviously is valuation, and it has been very difficult to place ourselves in this category, wherein, again, it is an example of growth visibility, and a lot of people have started to believe that this is a story wherein it is going to play out over the next decade. Although that is true, but one has to also look at diversification within the client base. So what we don't like about a lot of these companies is that, they are heavily dependent on a particular client or a particular category. Secondly, I think so while valuations have been generally prohibitive, although we are a big believer in making India story, but what we have chosen is to play it through a unique company known as Tejas Networks, wherein we believe it is a combination of very high technological prowess, basically very high patents. So there has to be an entry barrier in the business. So what we don't like about the EMS business is that, it really doesn't have an entry barrier. And obviously, the margins reflect that to a certain extent. Obviously, a lot is going to be, mean reversion in terms of, again, the same factors playing through, which is normalization of raw material costs, so on and so forth. But it is going to be very, very difficult for a lot of these EMS companies to sustain margins. So I think so quarterly trends are very difficult to read through in this category. I think so we would go by the yearly trends in terms of, margins, because, in a particular quarter, something or the other keeps on happening, and whether they are in a position to, sort of retain that benefit of either freight or raw material needs to be understood well.
Aditya, I believe you've been bringing down your exposure to the financial space. At one point of time, you were overweight, or at least, in line, and now you're underweight financials. Your peak weightage of the financial sector in your book used to be 34%. It's down to 23.5%. Can you take us through that call, and where exactly are you, doing some profit booking?
So, two things here. One is that financials have become a disproportionate weight in the index. Obviously, as a percentage of overall Nifty profits, it is close to 37%. So, purely from a cyclical perspective. Secondly, our belief is that, the best of credit cost is behind us. Thirdly, the retail lending side of it, clearly the trends which are emerging, and we are at a very early stage of those trends, in the sense that if you look at, SBI cards, for example, the gross slippages number, or even if you look at, Bajaj Finance, what you'll find is that, the GNPA has been rising on the urban and rural B2C business. So what you'll essentially find is that, we would take a cyclical call, a gradual overweight becoming underweight. Some small finance banks have, done reasonably well. For example, we continue to be, invested into Equitas Small Finance Bank and CSB, but a bit of profit taking is also required, because what we have seen is that, these stocks have gone up by 70 to 100% over a 1 year rolling basis. So I think so it is a gradual tactical call wherein we are moving away from financials to segments that we really like and which were getting underrepresented in our portfolios. Consumer durable obviously is one space, second being consumer discretionary consumption. So we believe that, we have to move from, take some profits periodically just to do some weight readjustment in the portfolio.
Okay, got that. Thanks very much, Aditya. Appreciate you joining in, and pleasure speaking with you as always. That's a very nice chat as always. We'll take a quick commercial break here. Markets are down 35 points, and we're at 18,500 with just 19 minutes to go for close. We'll take a break. We'll get you short-term trading ideas with our technical experts on the other side. More coming up in terms of opinion as well. Stay with us.